Well, at a time when global markets have come on the right side of the grease, China is melting away. India has emerged as the market of choice for global investors. I have with me a very special guest, someone who needs no introduction whatsoever, Chris Wood of CLSA. Chris, fantastic to connect with you. Thank you for joining us. Let's first talk about the global environment and what is your take on what is happening in Europe? We've come on the right side of the grease.
Yes, on the European equity situation, I've been formally recommending an overweight in European equities this year, which I continue to recommend. And the base case is to be overweight European equities is that we have QE, which is we've been learnt in the last few years is normally bullish for asset prices. We have stabilization in the Eurozone economies. We don't have, I would not call it a big cyclical recovery. It's just macroeconomic stabilization. And we have the anticipated sort of fudge over Greece. So I would still recommend an overweight in European equities.
But whichever way I look at the Greece episode, do you think euro is headed lower?
Now, personally, I think the euro will depreciate further because I think we're going to have ongoing QE. I think the easy money was made shorting the euro over the past year when Mr. Draghi launched QE. But if you said to me, you've either got to own the dollar or the euro for the next 2 years, I would own the dollar, and I'd be willing to own European equities on a hedge basis because I think we get ongoing QE. And in my view, while we haven't got formal debt relief for Greece yet, everybody understands that the debt situation of Greece is unsustainable. Therefore, what we've had is an extend and pretend fudge. But my guess is down the road, there will be an element of debt relief granted to Greece. I think there's a reluctance on the part of Germans to grant that debt relief now because that will be unpopular in other periphery Eurozone countries. So in Spain, we're due to have a general election before the end of the year. And it would make no sense to give formal debt relief to Greece before the Spanish election because that might increase the chances of the equivalent of the Syriza party in Spain.
Well, now, the Eurozone is more like a political experience.
Yeah.
And do you think the union itself is now looking broken? It's not fragmented. Greece on one side, France on one side, Finland on one side. Sweden is moving this way and that way.
Well, the Eurozone was conceived originally as a political project to try and integrate the Europe because of the unfortunate history. So there's huge commitment on the part of the Germans to maintain the Eurozone in its present form. However, because it was politically driven, people chose to ignore the obvious defect of the Eurozone, which is that you can't, any economist could tell you, it's impossible to have a monetary union without a fiscal union. That's why Mrs. Thatcher was always against joining the euro for quite correct reasons. And that's why fundamentally the thing cannot work unless you move to fiscal union as well.
What's your take on when Fed would move? Enough and more has been discussed. In fact, the Fed rate hike has been discussed ad nauseum.
Yeah, I couldn't agree more. The federal rate hike has been discussed ad nauseum. Basically, every year since 2009, the economists have been predicting Fed rate hikes and acceleration of the US economy. What's happened every year so far is that the GDP forecasts of the Fed and 99% of economists have been downgraded. What's happened in reality is the US economy has been growing at a trend growth rate of between 2–2.5% in real terms year on year. So far, there's no convincing evidence that we're breaking out on the upside of that growth range. So that's why personally I'm still skeptical about whether the Fed raises rates this year. But regardless of what I think the key issue to keep an eye on is wages in the US. We've had job growth for several quarters now, but the job growth, while it looks okay, is not as great as it looks in detail because a lot of the jobs are low quality. The unemployment rate is not as low as it looks on the superficially because of the significant decline in the labor force participation rate in America. So what I believe the key variable is wages. If we get material evidence in coming months of rising wage pressures accelerating beyond the very anemic level we've been in since 2009, then I believe Mrs. Yellen will raise rates, try to raise rates. But so far, we haven't seen conclusive evidence of accelerating wage pressures.
And is the US bond market telling you not the true story? Because as we speak, the 10-year is north of 2%.
Yeah, but that's not, the 10-year bond yield though is still pretty low historically. Although the bond market has sold off a bit, it's selling off from extremely low yield levels, and that sell-off occurred at the time that we had a sell-off in Eurozone bonds from very low levels. But to me, the key issue is not what the bond market is signaling now. The key issue is how the long end of the bond market would react if the Fed starts raising rates. So my base case is if the Fed does start raising rates, and my base case is they will not, but if I'm wrong and the Fed does start raising rates, the key issue will become how does the bond market react. My guess is the bond market will flatten, not steepen on a Fed rate hike.
Are you a bit surprised with the Armageddon or the sell-off in commodities? Just about every major industrial commodity is down by about 15 to 20% this year.
No, I'm not surprised about that, because the Chinese, what we're seeing in the commodity market is growing capitulation to what's been clear for some time, that the Chinese commodity super cycle has peaked, and frankly, that's partly natural, partly induced by the Chinese government, because the Chinese government is in the midst of an effort to restructure its economy from investment-led growth to consumption-led growth, which actually is what China needs to do if it's going to have a sustainable, healthy future. So they are trying to do that, and they're having a certain success in that. But the downside of that is that the commodity super cycle is over. That's been signaled by the markets for some time, and the further negative of the commodity super cycle was clearly oil and the Saudi Arabia's change in policy last year. So what I was surprised about was how bullish people became on commodities in the second quarter of this year. I would remain underweight commodity plays in emerging markets. In fact, that's one big reason I remain heavily overweight India, because it's the major emerging market which is a net beneficiary of lower commodity prices, lower oil prices. Although clearly there are commodity-related stocks in the Indian stock market.
But is India the only game in town right now?
No, India's not the only game in town, but the two big Asian countries or economies who are net beneficiaries of lower commodity prices, and who both, in my view, can ease monetary policy more, even if the Fed starts raising rates, are China and India.
For the longest time, you've liked Indian equities. It's out there in public. But what you like within Indian stocks are private banks. What makes you so bullish on private banks?
Well, I've always had Indian private banks in my long-only portfolio since I started back in 2002, and that's simply because I think Indian private banks are a secular growth story, partly because there's a big banking market still accounted for by state-owned banks, therefore they can continue to take market share. And clearly, Indian credit penetration is low, so it's just a natural long-term growth story.
What about the valuations? A stock like HDFC Bank is trading at 4 times book, Axis Bank 3 times book. Do you still like them at these valuations?
Well, I mean, the question is, do you continue to hold them? Whether you buy them with new money is another matter, but I'm more of the view of holding them. The issue is, in India, do you want to move your stock selection from quality private sector banks to more high beta, cyclically orientated stocks, which may be cheaper but riskier, and it only makes sense really to do that aggressively if you become convinced that India is on the brink of cyclical economic acceleration, and that does not remain clear as yet.
So you're not of the view that a fresh investment stroke capex cycle has started in India?
Well, to me, there's no convincing evidence of a new investment cycle as yet in India. There's a lot of evidence that the economy is in the process of bottoming out, and we're sort of in a plateau-like formation, but in terms of real overt cyclical acceleration, I'm not aware of any clear evidence.
In a recent note, you've made a point that the Modi government has not been very open about addressing the problems in PSU banks. Is that the single biggest worry for Indian economy stock markets? PSU banks, they are in a serious disarray.
Well, I think the big issue, the big relative negative for the Indian equity market this year has been disappointing earnings relative to expectations. But I think that can partly be explained by the big decline in nominal GDP growth, Because if you look at real GDP growth in India, it's been basically flatlining, but you see a significant decline in nominal GDP growth, which reflects the fall in inflation. So that's partly, that's a negative, which is also positive, because that's powerful evidence that inflation is coming down. And in my view, that creates big potential for further monetary easing in the next 18 months in India. So to me, that's a big positive for Indian equities, a big potential monetary easing. However, the negative is what you just said, the lack of evidence of investment cycle. And I do believe that part of that relates to the failure of the current Modi government to address more proactively the legacy NPL issue in the state-owned banks. Much of it relates to infrastructure-related loans. And clearly, these state-owned banks will need to be recapitalized. And the sooner they're recapitalized, the better the chance you have of a new investment cycle. But obviously, there's a lot of questions of detail. How you recapitalize them? Have they formally acknowledged their previous bad loans? Have they written them off in a sort of realistic manner? Are they pursuing delinquent borrowers properly? Where are you going to get the new capital from the government, from the private sector? There's all kinds of issues, but my key point is this was clear before the present government got elected. We're now more than a year after they got elected, but on my most recent visit to India, I didn't get the sense that there was a clear strategy being announced about how to address this issue. But my point is it's an issue that doesn't just relate to the micro issue of a particular state-owned bank. It has macroeconomic consequences.
You're clearly not very bullish on global growth. If you're not very bullish on global growth, what will happen to outward sectors like IT and pharma? The kind of sound bites which we are picking up from pharma companies, be it Sun Pharma, or for that matter, TCS and Infosys, growth seems to be a challenge. Momentum is slowing down.
Well, no, it's quite clear that global growth is not accelerating. It's quite clear world trade has been declining all year. Asian export data has basically been disappointing. Very externally orientated Asian economies like Korea have got weak export growth. So it's clear when you're looking at export sectors globally or in India, it's bottom up. It's who's taking market share. It's not a big growth story.
What makes you so bullish on HFCs? You own, in your model portfolio, there is Grah Finance, and some would argue that Grah Finance is clearly one of the most expensive stocks in Asia. Forget about India.
Yeah, but I've had that for a long time, so I'm just a long-term holder.
Finally, Titan is out of your model portfolio. Why is that?
Well, that did very well for a lot of years, but that was partly related to the issue that gold prices were coming down, and that was partly a question of taking profits. But Titan is more high-end discretionary consumer, whereas Grah Finance is just, obviously, to me, more of a secular theme.
You're not bullish on real estate prices in general, at least in India, but you do have some real estate names in your model portfolio.
Yeah, but I don't have a big, I only have one, and that's more geared to commercial property. Personally, I'm more constructive on commercial property in India, which has higher yields and less supply than the residential property market. The residential property market is clearly suffering partly from high rates and also partly from the what you call the crackdown on black money. I think has had spillover effects.
I remember distinctly in 2005, a big mega trend which you identified was that Indian property stocks were cheap, the market capitalization was at a real-time low, and that was the big opportunity. In the next 3 years, we saw DLF and a Unitech got created. So what is the mega trend for next 3 years, according to Chris Woods?
No, I mean, to me, the big mega trend, I think one big mega trend will be whether Mr. Modi can really implement this agenda of giving states more autonomy to run their affairs, and thereby create a competitive dynamic where states are competing for investment. To me, that could be very, very beneficial on a 5-10 year view, but it's not going to show up in the next 3 months. But to me, the big macro issue in India is evidence of a new investment cycle. Once you get evidence of a new investment cycle, then I think the equity market will be in a virtuous cycle again, like it was between 2003 and 2009.
So at the current juncture, do you think Indian markets are priced to perfection? Earnings have not caught up, but Ps have expanded, and Ps are unlikely to expand now?
No, I think the obvious risk for the Indian equity market is the fact that the earnings have been running below consensus expectations. So the consensus expectations are way above what's being reported. So that's the reason to sell Indian equities today. The reason to buy Indian equities is that there's huge potential, in my view, to ease monetary policy on an 18-month view. So I would say the potential for monetary easing offsets the potential derating risk on earnings. And then the other issue is I'm hoping that by the end of this fiscal year, we will start to see more evidence of an investment cycle pickup. And the other, obviously, you've got this other outlier in India, which is creating a lot of attention in the private pre-listed market, but not in the listed market, is obviously the e-commerce story. Though personally, I think the e-commerce story in India is not going to be as explosive as in China. I think it's a very promising story, but I don't think it will be as explosive as in China. One, because the infrastructure in China is far superior and therefore lends itself better to e-commerce. But two, there's the language issue. The Chinese e-commerce companies are operating their own universe because of the language, where the Indian e-commerce players are up against the US multinationals.
That's a great point. So you think India will never be the mecca for e-commerce companies?
Not to the degree it's been in China, where you have these national champions who have done phenomenally well, have huge growth, and are operating in their own paradigm.
So after this interview, if a client walks up to you and he's got two questions, give me what could be the best performing market from a 3 to 5 year time frame, and within that best performing market, what could be the big groups?
Well, no, I think of an investment cycle. We get evidence investment cycle. India has got as good a potential as any major market on a 5-year view. But for now, frankly, until we have evidence of a really economic upturn, I'm just as happy owning the 10-year Indian government bond as I am owning Indian equities.
What's gone wrong with gold?
And gold will be a function of what happens on US monetary policy. So if you're based in Australia, gold's gone up this year because the Australian dollar's gone down. But from a US dollar-based person's perspective, the key issue is, can the Federal Reserve normalize monetary policy? The consensus believes that the Fed is going to be able to normalize US monetary policy and raise rates without a problem. If that proves to be the case, then gold will decline further. In fact, I think gold will decline to the 1,010.50 level if the Fed starts raising rates. However, if the Fed tries to raise rates but then cannot, and the economy stalls and has to reverse policy, then and it becomes clear that the Fed can't escape the zero rate policy, then I believe gold will go into a new bull market. So I think the key variable is US monetary policy.
Frankly, the problem for India has been that inconsistent communication on the tax policy. First it was GAR, then it was MAT. Now we are picking up some more renewed concerns on pay note.
Oh, on the foreign investors
That's right.
No, that's been a series of unfortunate own goals.
So you think those investors who invest in India, they're accustomed to these random policy changes?
No, I think the specialists are. I'm not sure the non-specialists are, but the specialists, experienced investors in India, are extremely accustomed to it. But so clearly it's not helpful.
In general, if you have to, let's say, put a number to the Sensex for next 2 years, next 3 years, where do you think the Sensex to the Nifty could be?
And I don't have a number. I mean, I'd be... To me, it's all about whether there's an investment cycle. If we don't get any material evidence of an investment cycle pick up in the next 2 years, then there's not going to be much upside in the Sensex.
But the government is trying their bit to kickstart the investment cycle. Frankly, the corporate balance sheet is bust. Government is doing their bit now. They're forcing PSUs to start a new capex cycle. They're looking at mega projects in the defense space. Railways, the tap has just started. So are they doing their bit?
No, the government can do a certain amount, and that's fine, but you want a private sector-led effort too. So from a purely private sector standpoint or market-orientated standpoint, the best way to recapitalize the economy would be to privatize the state-owned banks.
That's not going to happen. Let's be real about it.
No, right, but that's a negative. It would be much better if they were privatized. This distressed asset, these distressed banks sold to private sector enterprises taking advantage of a distressed opportunity. So that would be the quickest way to revitalize the Indian economy.
One outlier in your model portfolio is Coal India. You don't like commodities. You've historically never recommended your clients and investors to buy into PSU companies. Why Coal India?
And Coal India is just another more low beta stock, precisely because we haven't got an investment recovery, but Coal India, coal production is going up, and they look relatively attractive.
Are you excited about what the government has done when it comes to e-auctions? There is finally a policy in place how to auction natural resources.
Now that's, I think, one of the big successes. The coal production going up is a big success. That, of course, has now refocused attention on the age-old problem of the lack of purchasing power for coal, because the state-owned most state-owned electricity boards are in very bad financial condition. So the question is, will the government now address this issue?
Is Maruti the only way to bet on cyclical recovery?
It's not the only way, but it's a straightforward way, because Maruti's got a dominant market share. Indian car sales were running well below trend for several years. When I last checked, I believe about 80% of car sales are financed, and in my view, I'd be surprised if there wasn't another 150 basis points of monetary easing between now and the end of next year.
Is rate easing just a necessary condition but not a sufficient condition for the investment cycle to pick up?
No, it's not sufficient. It's necessary, but in my view, not sufficient.
So what are the other sufficient
Well, I think the other key
conditions?
thing is sorting out the banking system.
Until the time PSU banking problem is not sorted out, you're not very hopeful on an economic recovery.
Well, there's three things, actually. There's lower rates, sorting out the banking system, and the third one is just time, because the corporates who are balance sheets are in not good condition are gradually being repaired.
In general, do you think the challenge for India is that it's a crowded trade now? According to MSCI and most of the experts who are specialists, India is an overweight.
Yeah, but I mean, that to me is that's always an issue. But the fact is, India's weighting in these benchmarks, in my view, is absurdly low. So in my view, you should be structurally overweight India, because the benchmark weighting of India is too low relative to the importance of the economy and the quality of some of the companies. But it's quite clear, yeah, specialist Asian emerging market investors, my guess is, are overweight India.
A year from now, if you're interacting on the same forum, will you be super bullish? What will happen to your conviction levels?
Well, it all depends. We get an investment cycle, but there's one issue of the absolute case for India in equities, and that relates to whether we get an investment cycle. There's another issue of the relative case for Indian equities in the context of Asia and emerging markets. And the fact that India is the economy least negatively geared to commodities is a reason by itself to be overweight India, even if nothing good was happening in India. So there's a relative case and an absolute case.
And an average
But the other point is that Mr. Modi's, has probably got the most aggressive pro-investment, pro-growth agenda of any political leader I can think of.
And an average Indian, they should sell gold and they should buy Indian stocks?
No, actually, an average Indian should own a bit of gold, but there's less reason for an Indian investor to own gold, actually, because the monetary policy in India is very tight.
So equities is the way to go?
No, and bonds. Indian investors who are conservative should own long-term government bonds.
Okay.
The yields are very positive in real terms.
Okay.
Inflation's fallen. So I think I'm advising foreign investors to own Indian government bonds as well as Indian equities.
Mr. Woods, really appreciate your time.
Thank you.
Glad you could join us. Doesn't get bigger than this when you have Chris Woods outlining the case for India and what is the way forward for Indian stocks. He's of the view that if the investment cycle does not pick up, it could be a no-no for Indian stocks in coming years.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.